Welcome back to the Deep Dive, where we tear down the world's most complex and volatile investment stories to deliver you the essential, actionable insights.
And today, we are strapping ourselves into what might be the fastest moving vehicle on Wall Street.
That's right, we're talking about Carvana Co., ticker CVNA. This is a company that has really redefined volatility.
I mean, it's moved from the absolute brink of insolvency to an $87 billion valuation in what, the span of 36 months?
It's incredible.
It's truly the story of the decade. We're looking at a stock that was, for all intents and purposes, given up for dead.
Price near zero.
Exactly. And it has executed a complete, and I think we have to say, often brutal operational transformation. Carvana went from existential peril to triumphant resurgence with a velocity that just demands our attention.
And that velocity is precisely the center of our investigation today. The market has delivered this staggering verdict, right? Carvana is back, it's profitable, and it's ready to scale. But this brings us to the $87 billion question. Has this so-called Amazon of auto truly created a structurally superior model, one that rewrites the unit economics of the industry? Or is this current trajectory, just built on transient macroeconomic sands and a spectacular short squeeze?
Well, we've taken a really rigorous look at the stack of sources you provided. We applied a highly structured value investing framework augmented with some deep data analytics. And here's the immediate headline for you. The stock is currently priced with, I have to say, impressive efficiency.
Interesting. So not overvalued.
Not necessarily.
Yeah.
We found the math dictates that the current share price, which is $399.77, giving it that massive market cap of roughly $87 billion as of today, December 6th, 2025. It sits squarely within the intrinsic fair value range.
So if the price is fair, we are not talking about some explosive bargain where the risk is clearly mismatched with the reward.
No.
Where you're talking about a rational price for a company that is being priced for operational perfection. It leaves zero margin for error.
That's the key takeaway. And it leads us directly to a neutral hold outlook.
Okay, so we're going to walk everyone through exactly why our DCF model dictates that specific conclusion.
That's our mission today. We have to dissect how management executed that pivot. We have to evaluate the tangible barriers to entry they've built, that so-called structural moat.
Right.
And finally, we have to weigh the significant market risks, which includes the really complex impact of the 2025 tariffs on auto parts, which it actually turns out to be a bit of a double-edged sword for them.
Okay, let's unpack this. Let's get into the guts of the business model. Here is the roadmap.
We will begin with Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1, Business Understanding. So Carvana is fundamentally about digitizing the vast, frustrating friction that exists in the traditional used car retail space. I mean, for anyone listening who has spent a whole Saturday sitting in a dealer waiting room dealing with opaque pricing and haggling, you get the problem.
It's a universally disliked experience.
Exactly. And Carvana's core model is, on the surface, elegantly simple. It's a vertically integrated e-commerce platform that just removes the human element of haggling and the geographical constraints of a local lot.
And that ability to remove that friction is what allows them to even target an $87 billion valuation.
Right.
You have to think about how fragmented the industry is. I mean, traditional dealers, they're physically constrained by their local foot traffic and whatever inventory they can physically store on site.
So they're limited.
Completely limited. Carvana solves this by leveraging a national logistics network. And this allows them to aggregate supply and demand across the entire country,
providing a selection that local incumbents, even the big regional ones, they just can't match it.
They simply can't. It's a pure high-volume aggregation play that demands just massive, massive infrastructure.
And crucially, they're not just an inventory aggregator like a classified site or something.
No.
They own the transaction end to end, and that allows them to capture revenue from multiple synergistic sources.
Correct. And that $20 billion revenue run rate is generated through three distinct, and I'd say mutually reinforcing streams. The first is, pretty obviously, retail vehicle sales.
Okay.
This is the primary driver of the top line. They source cars from trade-ins, wholesale auctions, expiring leases. They run them through their extensive network of inspection and reconditioning centers, the IRCs, to meet this Carvana-certified standard, and then they sell them.
And the gross profit there is pretty straightforward, I assume?
It is. It's the retail price minus the total cost of acquisition, reconditioning, and transport.
That model requires incredibly sharp underwriting and pricing intelligence to make sure that spread is always positive. I mean, that's a massive data science challenge on its own.
Absolutely. Their proprietary pricing and underwriting algorithms are totally core to their margin control. But the second revenue stream, which is so critical for inventory management and cash flow, is wholesale vehicle sales.
Right, because not every car they get is going to be perfect for retail.
Exactly. Not every car they acquire meets that high Carvana-certified retail criteria. These units might have mileage that's too high or excessive damage, or they're just too costly to recondition.
And they need to be liquidated quickly. You can't have them sitting on the balance sheet.
Right, you need a lean balance sheet.
Yeah.
And this is where the 2022 acquisition of ADESA US just fundamentally changed their operating model.
Okay, let's dig into that. Before ADESA, they were paying third-party auction houses fees and transport costs to get rid of these units, right?
Exactly. They were a customer of the auction houses. By acquiring ADESA, which is the second largest physical auction network in the U.S., Carvana internalized that whole process.
So now they monetize these wholesale units more efficiently.
Much more efficiently. They capture the auction fees themselves, which is a high-margin service, and they drastically reduce the internal logistics costs of moving these wholesale cars to third-party sites.
So it's like a crucial internalized release valve for inventory liquidity.
It is, and it significantly enhances corporate margin control. It's a huge deal.
Okay, now let's talk about the stream that really justifies that tech company multiple rather than the cyclical retailer multiple. Other sales and revenues, this is where the real money is, isn't it?
This is absolutely the highest margin component of the entire business, and it's crucial to achieving that overall gross profit per unit, the GPU, that's exceeding $7,000.
Oh.
This stream has two primary components. First is the origination and sale of automotive finance receivables,
Loans.
the loans. Carvana uses a hybrid financing model, so they originate the loan to the customer, but rather than keeping that high-risk, long-term credit exposure on their own balance sheet, they immediately offload those loans.
They sell them to third parties or bundle them into securitization deals, so they get the immediate profit margin from loan origination, but they don't hold the long-term credit risk.
Exactly. It's smart risk management.
Very smart.
It optimizes cash flow and reduces balance sheet risk dramatically. Second, and equally important, are the value-added services, or VAS.
The add-ons.
These are the high-margin insurance products, like vehicle service contracts, VSCs, which are basically extended warranties, and gap insurance. Yeah. The success of this stream really hinges on the attach rate.
Okay, let's pause on that. For our listener, the learner, can you explain what a high attach rate means, both for the customer and for the company?
Of course. A high attach rate means the percentage of customers who buy the car also purchase these ancillary products.
Makes sense.
And when you're buying a used car, a VSC offers, peace of mind. It removes that nightmare scenario of a major breakdown right after you buy it.
Right. And Carvana's whole process is streamlined and non-confrontational.
Exactly. Their online buying process makes adding these products feel less like a high-pressure dealer pitch and more like just a simple checkbox during the checkout.
So it's easier to say yes?
Much easier. And because VSCs and gap insurance are pure service agreements with very high profit retention, a successful attach rate is arguably the single most important lever for driving corporate profitability and achieving those exceptional GPU figures.
That focus on removing friction, it translates directly to the value proposition. The three core pillars you identified are certainty, convenience, and selection. And that certainty part, the 7-day money-back guarantee, that is revolutionary in the used car industry.
It's a complete cultural shift. The traditional model is usually as is, where is.
Right, buyer beware.
The 7-day guarantee fundamentally reverses the risk away from the buyer and puts it on the seller, something the traditional model relies on heavily.
And then there's convenience.
Powered by technology. You can complete the entire purchase, including financing, a trade-in quote in about 10 minutes on a mobile device, all thanks to their proprietary algo pricing engine.
And selection is the one that consumers feel most immediately.
That's the one. They offer a national inventory of over 50,000 vehicles. So if you live in a dense, expensive market like San Francisco, you are no longer limited to the 200 cars on a local lot.
You have access to everything.
Everything. And Carvana handles the logistics of getting it to you.
Yeah.
Whether that's via a flatbed delivery truck or one of their famous car vending machines.
Okay, so let's talk about the actual competitive advantage, the moat. Any startup can build a shiny website. The barrier to entry, as you mentioned, it must be the infrastructure.
It is the logistics and reconditioning infrastructure. This is the extremely high capital hurdle that just slams the door shut on new startups.
It's too expensive to copy.
Immensely. Replicating what Carvana has built requires just immense resources. A competitor would need to acquire or construct dozens of these industrial-scale IRCs. These facilities are essentially automated factories for used cars.
And then you need the trucks.
And then you need a dedicated national transport fleet capable of managing thousands of cross-country deliveries every single day. This scale demands billions of dollars in sunk capital and several years of just painful operational development.
And the crown jewel, the strategic fortress you mentioned, is that ADESA U.S. acquisition. Let's spend more time on this pre-zoned real estate. Why is zoning for automotive reconditioning so difficult? And how does owning these 56 sites give them an insurmountable structural advantage?
Okay, so zoning is the hidden key here. It's the boring part that's actually the most important.
Right.
Industrial land that's suitable for automotive reconditioning and large-scale vehicle storage is notoriously difficult to acquire and get approved,
Why is that?
especially near major metropolitan areas where demand is highest. These IRCs, they generate noise, traffic, and specific environmental considerations that municipalities often just block outright.
So it's a not in my backyard problem?
Exactly. But ADESA gave Carvana 56 existing pre-zoned industrial real estate sites that are already approved for this purpose. This isn't just a cost saver, it's a time machine.
A time machine, how so?
It accelerates their growth timeline by years because they don't have to fight local zoning boards for every single new facility.
That's fascinating. It just completely eliminates the regulatory drag, and it translates into immediate operational gains.
Precisely. Integrating those ADESA sites strategically into their reconditioning workflow has allowed them to significantly optimize their logistics.
We have numbers on that, right?
You do. In Q3 2025 alone, they reported reducing average inbound transport distances to their IRCs by approximately 20%.
20%.
And less transport distance means lower fuel costs, lower driver wages, and faster cycle times, all of which feed directly into that improved GPU.
So they've built the physical moat, but they also have these massive secular tailwinds pushing the consumer right toward them. The two big ones are the affordability crisis and the Amazon effect.
The affordability crisis in the new car market is a fundamental driver for them. New vehicle prices have just soared, driven by technology integration, semiconductor shortages historically, and the high cost of electrification.
And that shift is actively pushing traditional new car buyers, people who used to buy a brand new sedan every 3 years, into Carvana's sweet spot.
Exactly. The late model 2 to 4-year-old used car market.
So Carvana is basically benefiting from consumers being forced to find value elsewhere.
100%. They are the beneficiary of macroeconomic strain. And at the same time, the Amazon effect is a cultural driver.
What do you mean by that?
Millennials and Gen Z buyers are digital natives. For them, the transparent, no-haggle, online-first experience isn't a novelty. It's the baseline expectation for any major transaction. The idea of spending 4 hours in a dealership is culturally alien to this demographic.
And despite this massive momentum and a TTM revenue run rate approaching $20 billion, we need to anchor the valuation in context. The total U.S. used car market sees what, 35 to 40 million transactions per year?
It does. And Carvana's share is still in the low single digits.
Still tiny.
And this is the crucial point for the bull case. They don't need to invent a new market. They just need to continue consolidating this highly fragmented, multi-billion-dollar traditional industry. The long runway for growth, scaling toward their goal of 3 million annual units, is what that $87 billion valuation is betting on.
Chapter 2, Management Evaluation. Okay, let's pivot and look at the leadership. Because the business model is great on paper, but this entire story only works if you trust the management team behind the wheel.
Absolutely.
We have to talk about CEO Ernie Garcia III and the two really distinct eras. The early growth at all costs era and the later post-2022 efficiency and profitability era.
Yeah, the early era was pure vision. It was focused entirely on that infrastructure build, which was massive and extremely expensive. That strategy led them directly to the brink of insolvency in 2022.
When the macro environment just turned on them.
Turned on a dime. Soaring interest rates and a sudden price collapse in used cars hit them incredibly hard. The true test of management quality, however, wasn't the vision. It was the response to that existential crisis.
And the response was, as you said, brutal. but necessary. Walk us through the specific actions they took that saved the company.
Okay, so the management team executed a complex, multi-layered debt restructuring. That involved some very contentious negotiations with
I
creditors.
can imagine.
But more importantly, they executed an aggressive internal pivot. This involved massive nonlinear cuts to SG&A selling, general, and administrative expenses.
How big were the cuts?
They reduced SG&A by over 40% in just 2 quarters.
Wow.
This meant significant layoffs, closing underperforming smaller hubs, and stopping all non-essential capex. It was a complete cultural shift to focus strictly on unit economics and profitability over market share at all costs.
That type of rapid operational contraction is incredibly difficult to pull off without collapsing the entire business.
It is. It's a miracle they survived it. The result, however, is the proof of execution. We saw that record-adjusted EBITDA of $637 million in Q3 2025.
So it worked.
It worked. This demonstrates that the Garcia team are not just visionary disruptors capable of spending capital, but they are also highly competent, decisive operators capable of generating cash flow when their backs are against the wall. That competence validates the operational side of the bull thesis.
But where there is operational brilliance, there is often concentrated risk. We have to address the governance issues that are, they're impossible to separate from the Carvana story. This is the governance discount that plagues the stock.
This is where we need to apply maximum critical analysis. There is a persistent debate over the relationship with drive time.
Which is the buy here, pay here chain controlled by the CEO's father, Ernie Garcia II.
Exactly. This interconnectedness fuels investor skepticism about self-dealing and undue influence.
And that skepticism manifested dramatically in January 2025 with the Hindenburg research allegations. What exactly were they claiming, and why does that structural interconnectedness still matter, even if Carvana denied all the claims?
Right. So the Hindenburg report specifically claimed that the turnaround was artificially aided by undisclosed related party transactions. The allegation centered on Carvana selling loans to affiliated entities to potentially inflate revenue and cash flow figures during that crucial stabilization period.
And Carvana's response?
They vehemently denied the claims, of course. But the fact remains that the Garcia family maintains extensive influence over both entities. For institutional investors, this lack of full separation remains a major point of skepticism and requires a governance discount to be applied to the valuation.
Compounding this is the dual-class share structure. The Garcia family holds super voting control via Class B shares. For the minority shareholder, the learner listening to this deep dive, how does that dual-class structure practically affect their influence?
It is absolutely critical to understand this. The Garcia family holds only a minority economic stake, but they retain a supermajority voting stake.
So they have permanent control.
Effective permanent control over the company's direction. This means that if a large institutional investor, say Vanguard, disagrees fundamentally with the CEO's strategy, they would be essentially powerless to force a change through a shareholder vote.
So management isn't really accountable to the public market.
This structural insulation reduces their accountability, and it's a major reason why Carvana's valuation, despite the growth, will always carry that governance discount.
Let's shift to capital allocation. Post-ADESA, the strategy seems more mature and focused on maximizing existing assets rather than aggressive new spending.
That's the sign of a healthy pivot. Following that massive $2.2 billion ADESA acquisition, capital deployment has dramatically shifted to CapEx light.
How light?
They spent only around $150 million in 2025, focused solely on the integration and utilization of those existing industrial sites.
So they're signaling to the market the big build is mostly done.
Exactly. Now, we are focused on generating maximal returns from the asset base we already own.
Okay, what about insider sentiment? The people closest to the fire, are they buying stock?
The signal here is mixed and requires real caution, especially given that price for perfection valuation we talked about.
They're selling, aren't they?
Insiders have been consistent net sellers during this impressive 2024-2025 rally. For instance, CEO Garcia III sold $3.5 million in shares back in September 2025.
Now, he used a prearranged 10b5-1 trading plan, right?
He did. And while these plans are standard for diversification, consistent selling by leadership during a dramatic bull run is a red flag. It suggests that the people who know the unit economics best may feel the valuation is already full.
And that the majority of this sharp upward move is behind them.
It's a data point you can't ignore. But the operational results do counter that skepticism to a degree. The financial metric that truly validates the ADHA investments and all that capital spent, the return on invested capital.
The ROIC.
It's the ultimate validation. The normalized ROIC hit an impressive 20.45% in late 2025.
That's huge for a retailer.
For an asset-heavy retailer that requires significant infrastructure, achieving returns well above 20% confirms that the capital spent on the logistics network and the ADHA sites is now yielding returns significantly higher than the company's cost of capital. That single number justifies the entire business structure and transformation.
Chapter 3, Financial Health. Now we get into the engine room, the financials that have driven the stock toward $400. That $87 billion market cap is the starting point for understanding why we call this a highly rational price.
Yeah, that $87 billion figure is the market statement, it says. We are explicitly pricing CVNA as a scalable technology platform, a high-growth compounder, not just a cyclical auto retailer.
This valuation multiple puts them in the league of premium disruptive tech companies.
It does, despite their core product being a used car.
The revenue journey has been the classic J-curve of high-growth disruption, massive spending, a near collapse, and now a profit-focused resurgence.
We saw that trajectory very clearly. Hypergrowth in 2021, then a steep contraction in 2023 when they had to stabilize the balance sheet, and now a massive resurgence.
What are the TTM numbers?
Trailing 12-month TTM revenue is back up to $18.27 billion. And Q3 2025 revenue came in at $5.65 billion, which is a powerful 55% year-over-year increase.
And that was achieved precisely when they were prioritizing margin expansion.
That's the key. That simultaneous acceleration of growth and profitability is the hallmark of a successful pivot.
Let's talk about that margin transformation. Wall Street demands proof that this model is structurally profitable. So what do the gross and operating margins tell us?
They tell us the transformation is real and it's durable. TTM gross margin is now 21.37%, consistently supported by that gross profit per unit, the GPU, exceeding $7,000.
But the real inflection point is the shift to genuine GAAP profitability, right? That's what's necessary for long-term credibility.
Absolutely. And in Q3 2025, the company reported a GAAP operating margin of 9.8% and critically a net income margin of 4.7%.
Which translates to how much in actual dollars?
$263 million in pure net income.
Wow. That 4.7% net margin is huge. It means after paying for all operations, SG&A, interest, and taxes, the core model is generating pure value.
It is the difference between a failing growth story and a successfully realized business model. It signals that the expense cuts were permanent and that the integrated infrastructure is now generating profits, not just consuming cash.
And that profitability immediately solves the biggest problem they had during the build-out phase, which was cash flow.
The cash flow pivot is absolutely vital for their debt profile. Historically, Carvana burned billions annually to build that IRC network.
Yeah.
Now that is completely reversed. TTM operating cash flow sits at an impressive $2.27 billion, with free cash flow to the firm reported around $433 million for the recent quarter.
And this cash generation is the financial engine that lets them service their substantial debt load.
Right, without relying on further shareholder-diluting equity raises.
Okay, so let's confront that substantial debt load. For value investors, the $4.6 billion in total debt is still a massive risk factor.
It is the most significant financial constraint, no question. Total debt is approximately $4.6 billion. That pushes the debt-to-equity ratio up to between 1.54x and 1.90x.
Which is undeniably high for a traditional retailer.
It is. However, context is everything here. The leverage profile is rapidly improving because their EBITDA is soaring.
Okay, so how does management measure that improvement to reassure the market?
Management focuses on the annualized net debt to adjusted EBITDA ratio. And because the EBITDA has grown so fast, this ratio has fallen dramatically to approximately 1.5x.
So that puts them in a much healthier credit tier than they were a couple years ago.
Much healthier. It signals to creditors and shareholders that the cash flow being generated is more than sufficient to cover their obligations.
And on top of that, they have fantastic liquidity, which acts as a safety cushion against any unexpected market turbulence.
Their liquidity is exceptional.
Yeah.
The current ratio is 4.05.
Yeah, and that measures.
It measures their ability to cover short-term liabilities with liquid assets, and 4.05 is an exceptionally strong figure. This buffer is reinforced by a massive cash balance exceeding $2.1 billion.
So they have substantial insurance against market shocks or minor operational setbacks.
They do.
Let's get to the core valuation then. We know the stock trades at around 91x to 101x earnings. Let's truly put that into context by challenging that multiple.
Okay, this is the definition of a hypergrowth multiple. It's reserved for companies expected to compound earnings for decades.
So compare that to CarMax.
CarMax, their pure-play competitor, usually trades around 20-25x earnings. And fragmented traditional dealer groups might trade in the 8-12x range.
So by trading at 100x earnings, the market is demanding total, utter perfection. There's zero room for execution error.
None.
If they miss 1/4 of profitability, the stock could violently re-rate lower.
That is the critical insight. The market is pricing in the absolute successful achievement of every single future goal.
Okay, so to determine if this astronomical premium is justified, we have to run the gold standard of value investing, the discounted cash flow, or DCF, model.
We do.
So how did we set up the model? Because the result hinges entirely on the assumptions we feed in. I want you to challenge the assumptions used here.
Okay. We based the DCF on the company's own aggressive long-term goals. We assumed a robust revenue compound annual growth rate, or KGR, of 15% for the next 5 years,
15%.
which assumes they successfully scale toward their 3 million unit annual goal and solidify that logistics moat.
A 15% CAGR is enormous for a company already generating nearly $20 billion in revenue. What macroeconomic conditions must hold true for them to achieve that goal without significant stress?
They need two things. First, continued high prices in the new car market to maintain that substitution effect we talked about.
Right.
And second, continued manageable interest rates to keep used car loans affordable enough to drive volume. If credit markets seize up or new car prices suddenly normalize, that 15% CAGR target becomes highly aggressive.
And what about margins?
We also modeled adjusted EBITDA margins expanding to 13.5% over time, which is consistent with management's stated long-term targets. And that target relies entirely on the full realization of ADESA synergies and that high attach rate of ancillary services.
And what about the cost of capital, the WACC? Did the recent S&P news help lower the risk profile?
It did. We used a weighted average cost of capital, or WACC, of approximately 7.95%. And importantly, this WACC is relatively favorable because of the impending S&P 500 inclusion.
How does that help?
Well, the inclusion helps lower the equity risk premium by broadening the investor base and normalizing risk perception. It makes the company look structurally less risky to the market.
So we run those aggressive yet achievable assumptions, 15% CAGR, 13.5% margin, 7.95% WACC. Where does the intrinsic value land?
Our educational DCF model implies an intrinsic value range of $380 to $460 per share.
And the current prices?
$399.77. It sits almost exactly in the center of this fair value range.
That is highly efficient. The market appears to be highly rational here, and it's efficiently pricing in the successful execution of this phenomenal turnaround and growth plan.
But it leaves no cushion for the investor.
That brings us to our mid-segment break. If you are enjoying this deep dive into Carvana's operational, financial, and risk structure, please make sure you like and subscribe to Stock Analytics AI.
And remember, for $4.99 a month, you can get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives, giving you the shortcut to being well-informed on every major market mover.
Now that we understand the business model, the management quality, and the financials that underpin this premium valuation, we must look at how the market is reacting to this story and what structural risks remain outside of their control.
We transition now to Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment. Market sentiment is absolutely crucial for a stock trading at a forward PE of 100x. Wall Street has clearly turned extremely bullish on Carvana in late 2025, especially after that Q3 earnings beat.
Yeah, the current Wall Street consensus rating is a moderate buy, with an average price target hovering around $427.
So that suggests only a modest upside of about 7% from current levels.
Exactly. Analysts are clearly driven by the durability of the margin improvements and the confirmed profitability. You see some street high targets even reaching $500, so there's real optimism for the path toward that 3 million unit goal.
But the single biggest technical catalyst driving the stock right now, regardless of the fundamentals we just discussed, is the S&P 500 inclusion. Explain the mechanism of this structural bid.
This is a guaranteed boost. It's a huge deal. The announcement that Carvana will join the S&P 500 index, effective December 22, 2025, it's not optional for large index funds.
Right.
This forces passive index funds, the giant asset managers like Vanguard, BlackRock, and State Street, who benchmark to the S&P 500, to buy billions of dollars of CVNA stock immediately.
And this creates massive insensitive buying pressure.
That's the key word, insensitive. They buy the stock regardless of the $399 price tag. They're essentially buying the index, and Carvana is now part of the basket they have to own.
And this creates a powerful technical floor under the price through the end of the year and into early 2026.
It's a massive, non-fundamental factor supporting the current valuation.
What about the historical opposition? We know this was a favorite short target for a long time. Are the shorts still heavily involved, and could they accidentally fuel this rally?
Well, short interest has decreased significantly from the crisis levels of 2023 and 2024, when I think over half the float was shorted at one point.
Incredible.
However, it still stands at about 8.27% of the float, representing around 11.5 million shares. That is still material.
And what about the days to cover?
Crucially, the days to cover ratio is around 4.5 days. This means it would take shorts nearly a full week of average trading volume to cover their positions.
So in a rising market, especially with the S&P inclusion buying,
Any unexpected positive news or a sudden demand spike can trigger a violent mini squeeze as shorts rush to cover, and that just adds further upward pressure to the stock.
and looking at the charts, everything confirms this momentum, right?
The technical posture is undeniably strong. The price of $399.77 is trading well above both its 50-day and 200-day moving averages.
Which confirms a very strong primary uptrend.
A very strong one. The Relative Strength Index, or RSI, is sitting at 67. We noted earlier that an RSI above 70 indicates overbought territory. But it is standard for strong momentum stocks, especially those undergoing a massive technical catalyst like an S&P inclusion rally, to sustain overbought conditions for extended periods until that structural buying pressure finally subsides.
Chapter 5. Ownership structure. The ownership structure usually shifts pretty dramatically during a turnaround. The distressed investors who bought in at the bottom are now cashing out. So who is replacing them? Who is holding the bag now?
We are seeing a fundamental transition in the ownership registry. It is moving away from the highly opportunistic hedge funds and distressed debt investors
And toward.
toward high-quality, long-term institutional investors who actually believe in the durability of the model.
So who are the major institutional players buying in now?
The top institutional holders now include T. Rowe Price, holding nearly 12%, Vanguard Group at 9.5%, and BlackRock at almost 7%.
And as we just discussed with the S&P inclusion, Vanguard and BlackRock will be forced to significantly increase their stakes to match the new index weighting.
They will. And this shift signals growing market confidence that the profitability story is real and sustainable.
And the high concentration of ownership among these top institutions and the Garcia family, that has a real impact on volatility, doesn't it?
It creates a supply-side constraint. This concentration dramatically reduces the free float, the number of shares that are readily available for general trading.
Right.
So when you combine reduced float with mandated buying pressure from index inclusion, the scarcity of available shares means that even moderate spikes in demand can disproportionately exacerbate volatility.
Driving prices up much faster than a widely held stock could move.
Exactly.
Let's quickly revisit the governance and insider sales because they are intrinsically linked to this ownership risk.
We have to reiterate that despite the quality institutional buy-in, the dual-class share structure ensures the Garcia family maintains that super voting control.
So minority shareholders still have limited influence.
Very limited. And furthermore, the persistent insiders selling like CEO Garcia III's $3.5 million sale back in September is a data point of caution. When a stock trades at 100x earnings, every single insider sale, even under a 10b5-1 plan, is seen by the market as a sign that the people closest to the company believe the price is peaked.
And that increases the volatility risk exponentially.
It certainly does.
Chapter 6. Risk assessment. We have established that the current price is rational only if the company executes perfectly. So let's apply the necessary stress test and look at the threats and weaknesses via a classic SWOT analysis.
Okay. Looking internally, the strengths are really the foundation of the bull case. You have the vertically integrated infrastructure, the ADESA sites and the IRCs, the incredibly strong category-defining brand appeal, and their proprietary technology stack.
Things like Deal Score and Carvana Score.
Right, for superior underwriting and inventory management.
But the weaknesses are what keep the shorts engaged, particularly around corporate structure and that debt.
The governance risk from the dual-class structure is persistent and it's unavoidable. The absolute debt load of $4.6 billion, while manageable thanks to the cash flow, makes them highly sensitive to interest rate hikes and refinancing risk down the line.
And you can't ignore the reputational stuff.
No, we cannot ignore the lingering reputation issues from past regulatory skirmishes, particularly around titling and registration delays, which requires expensive, constant PR vigilance.
On the opportunity side, management has painted a clear picture of future potential that the $87 billion valuation is built upon.
The primary opportunity is achieving that 3 million unit annual goal. That would require tripling the current size of the business through scale efficiencies.
And they're supporting this with expansion of high conversion services like same-day delivery.
Exactly, currently rolling out in key markets like Salt Lake City, Chicago, and San Diego. This immediate gratification increases conversion rates and reduces costly advertising spend. And finally, fully realizing the ADESA synergies should continue to drive that gross profit per unit figure even higher.
And the threats are primarily external, focusing on that volatile macroeconomic and regulatory environment.
The main macroeconomic headwind is interest rates. Auto loan rates are hovering between 6 and 7% in late 2025.
And Carvana sells a monthly payment.
Exactly. High rates directly reduce affordability for the average consumer, and that could soften used car demand, especially in their subprime segments.
And wage inflation.
That pressures SG&A costs for mechanics and drivers. On the regulatory front, increased scrutiny from the Consumer Financial Protection Bureau, the CFPB, on junk fees and discriminatory lending is a very real risk.
Why does CFPB scrutiny matter specifically to Carvana's bottom line?
Because those high-margin ancillary products, the VSCs and gap insurance, they contribute so much to that $7,000 plus GPU, are often targeted by regulators as junk fees.
So any regulatory crackdown or cap on those product prices could directly and violently compress their overall corporate margins.
Immediately. It's a huge threat.
Let's dedicate some time now to the most complex risk opportunity, the 2025 tariffs. This geopolitical factor is influencing both their demand and their cost structure at the same time.
It is. The U.S. imposed a 25% tariff on imported automotive parts and certain vehicles. This is a genuinely double-edged sword. We should probably analyze the negative cost structure threat first.
Okay, so how does the tariff hit their internal reconditioning costs?
It directly increases their cost of goods sold. Carvana spends massive amounts of capital on parts tires, brake components, sensors, body panels to recondition the vehicles they sell in their IRCs.
And a lot of those parts are sourced globally.
Many of them are. So a 25% tariff means a direct increase in the reconditioning cost per unit. If they cannot pass those full costs onto the consumer immediately, it compresses their crucial gross margin.
Wait, so you're telling me a 25% tariff on essential parts is bad for a used car company, but you also concluded this factor is net bullish. How is that possible? Why is the substitution effect guaranteed to outweigh this cost increase?
Because the tariffs hit new cars even harder. The positive factor is the powerful substitution effect. Tariffs are expected to raise the price of new cars significantly. Analysts are projecting up to a $6,000 increase per vehicle for some models.
And when new cars become prohibitively expensive,
mass numbers of buyers substitute down into the used car market, which is Carvana's sweet spot. This creates an enormous demand tailwind driving up used car prices across the board.
So the demand shock and the inventory appreciation are stronger than the cost pressure on parts.
That is the historical verdict, yes. The appreciation in Carvana's existing used car inventory value, the holding gains, due to increased new car prices, often outweighs the increased cost of reconditioning parts.
So the tariffs are viewed as net bullish.
Net bullish for Carvana's revenue and inventory value, while the impact on margins is considered manageable because they can pass some of those costs along in a hot market.
Chapter 7. Conclusion. Okay, let's synthesize everything we've learned. The story of Carvana is a perfect microcosm of the modern market. Incredible execution, high risk, and intense volatility. What are the final arguments for the bull and the bear?
The bull case rests entirely on the successful crossing of the Valley of Death. The company now possesses a structurally superior, difficult-to-replicate logistics network built around those ADESA sites.
And it's generating real cash.
It's generating real positive cash flow, growing at exceptional 50+% rates, and it's backed by the technical floor provided by the S&P 500 inclusion.
And you add to that the massive demand tailwind created by new car unaffordability, and you have a seemingly bulletproof story of structural superiority.
They fixed the business, and now they're compounding. That's the bull case.
And the bear case is entirely about valuation and governance.
It is about the risk inherent in being priced for perfection. At around 100x PE, there is zero cushion against error. The high governance risk, The drive time connection, the dual-class structure-persistent insider selling, and external risks,
Such as?
such as rising credit delinquency in the auto loan portfolio or a material regulatory fine. Any of those could cause violent multiple compression overnight, potentially halving the stock price if the growth story falters even slightly.
So we circle back to our intrinsic valuation range, which respects both the potential and the risk.
We confirm the DCF-derived intrinsic value range is robustly set between $380 and $460 per share.
And the current market price of $399.77 is not cheap.
But it is rational. It's efficiently pricing in the successful execution of their ambitious growth plan over the next 5 years.
So what's the concluding outlook for you, the learner, who is absorbing all this information and deciding whether to act?
The final outlook remains neutral hold. For those currently holding the stock, riding the S&P momentum through December 22nd makes sense, but the risk-reward ratio is now, I'd say, unfavorable for new buyers.
What should they be watching?
You must monitor credit performance and the regulatory environment very closely. For new capital looking to enter, you have to prioritize a margin of safety. We would recommend waiting for a pullback to the lower end of that fair value range, perhaps around $350 to $360, before initiating a position.
Here's where it gets really interesting for the long term. We know the key competitive moat is the logistics and reconditioning infrastructure, specifically those 56 pre-zoned ADESA sites and the proprietary transport network.
That is the unique asset base that no competitor can easily replicate.
So, the final provocative thought we want to leave you with isn't just about Carvana selling cars, but about how they might expand the monetization of this structural advantage.
Right.
Considering the immense regulatory hurdle and capital requirement of building IRCs, the core question for long-term investors is this. Could Carvana monetize its real estate and logistics network through a separate B2B service offering?
Meaning,
Right.
selling services to other dealers.
Exactly. Perhaps offering reconditioning services or regional wholesale auction access to smaller, fragmented independent dealers who can't afford that infrastructure themselves.
Leveraging that unique asset base beyond their primary retail model would provide an entirely new, potentially high-margin revenue stream that's less sensitive to consumer credit cycles.
A pivot to monetizing the fortress itself.
That would further cement their competitive advantage and is the question long-term investors must be exploring as they look beyond the current growth cycle.
That is a fantastic thought to chew on, a deep dive into one of the most compelling turnarounds in recent memory. If you want more insights like this, make sure you like and subscribe to Stock Analytics AI.
And remember, this analysis was generated by an AI system based solely on the provided research documents for educational purposes. It is not financial advice. Please conduct your own research or consult a qualified financial advisor before making any investment decisions.
Thank you for taking this deep dive with us. Keep asking those complex questions, and we will see you next time.